subcommittee will reconvene. I will now introduce the panel. First of all, thank you for waiting for an hour and a half. No less, thank you for appearing before the subcommittee today. Without objection, your written statements will be made part of the record, and you will each be recognized for 5 minutes in summary, so we can move through your direct testimony and get to some of the examination of the committee members. First, we have Mr. Baird Wabel, Specialist in Financial Economics with the Congressional Research Center. Mr. Wabel, you're recognized for 5 minutes.
Chairman Kanjorski, Ranking Member Garrett, members of the subcommittee, thank you very much for your invitation to testify at today's hearing. First, just a formality to get out of the way. I just want to clarify that CRS's role is to provide objective, nonpartisan research and analysis to Congress. CRS takes no position on the desirability of a specific policy, and the arguments that I've presented in my testimony are for the purpose of informing Congress. My written testimony provides a range of options for Congress to consider as it approaches revamping the insurance regulatory system, and I would like to highlight a couple of aspects of it right now. The first is that the options that I present are not mutually exclusive. You can see that in the Bean-Royce bill that was mentioned by the members before. It combines both an optional federal charter and a systemic risk regulator. Insurance is a wide-ranging business. There are a variety of different regulatory approaches that you could consider, and a variety of different ways that you could split up the business if so desired. For example, the option of splitting the regulation of life insurance and property casualty insurance has been mentioned frequently. There's also a reinsurance component that could be considered. There is currently existing regulation that's very different at the state level between commercial lines insurance for large insurers and personal lines insurance that are bought by individual consumers. There are vast differences between the scope and reach of large insurers versus small insurers. There are aspects of market conduct or consumer protection that could be regulated differently than solvency. So that there are a lot of different options in different ways, and it's not necessarily the case that one size needs to fit all. The second thing I'd like to talk about is the newest concept that's really come out of the last year or so of specifically of a systemic risk regulator. As the newest idea that's really out there, it's also, I think, the least fleshed out of the concepts that we have. And as with so many things, the devil truly is in the details. Who would be the systemic risk regulator? What would a systemic risk regulator do? What would we want it to do? And starting just at the definition, even just at the definition of systemic risk, one finds frequently differing concepts. One of my colleagues, when we started into this discussion a few months ago, came around to the people that do this at CRS and said, so, is an asteroid about to hit the United States to be considered a systemic risk to the financial services industry? And after the sort of initial amusement at the idea, and when people started thinking about it, you start to take it a little more seriously. What is a financial systemic risk regulator to do about this? Is it regulating how people would respond to an asteroid strike? Is it supposed to be stopping the asteroid strike from the beginning? If you replace asteroid strike with, say, global warming, or a pandemic flu, or the destruction of the financial infrastructure in New York, suddenly it's not, it brings up questions that are really a little more serious than when you first thought about it. The powers that a systemic risk regulator could have. Does it have day-to-day oversight of financial firms? Or does it sit at 20,000 feet and identify the problems and then expect the other regulators to do something about it? If so, does it have preemption powers if it identifies a systemic problem, but the other regulators don't act on it? When you apply it to insurance, you get even more complicated because of the existing state regulatory system. Questions of how you balance federal power versus state power, of 50 different regulators that would have to be interacting with the systemic risk regulator. there's been a suggestion of a council with the heads of the various federal regulatory bodies. Well, who sits on that council for insurance? I mean, presumably you'd want to have someone there, but who? And when you get down into the very weeds of insurance, I think that there is a particular flashpoint with rate regulation. Many of the states consider rate regulation to be a bedrock consumer protection. But of course, suppression of rates beneath what is appropriate for the risk entailed is a definite solvency concern, which feeds into a definite systemic risk concern if it's a large insurance company. And how that could be managed within the system or within whatever the federal systemic risk regulator would be will certainly be a challenge. I'm happy to be here and happy to answer any other questions that you might have. Thank you.
Thank you very much, Mr. Wable. We'll now hear from Ms. Patricia Quinn, Managing Director of the Global Risk and Financial Services business of Towers Perrin. Ms. Quinn, 5 minutes, please.
Thank you. Chairman Kanjorski, Ranking Member Garrett, and members of the subcommittee, it's an honor to testify today on behalf of Towers Perrin. Towers Perrin is a global professional services firm that helps organizations improve their performance through effective people, risk, and financial management. The insurance industry is a particular focus of our firm, and I appreciate this opportunity to offer our perspective on the important issue of insurance industry oversight. Without a doubt, the financial crisis has had a significant adverse impact on the balance sheets and profitability of insurance companies. However, with the obvious exception of AIG, the insurance industry as a whole has not been as severely impacted by the crisis as has the banking industry. Insurers have benefited from strong risk management practices, particularly in the property casualty sector. In addition, the focus of the current state regulatory framework on solvency and policyholder protection has served the industry well. That said, the financial crisis has exposed a number of issues that raise valid questions about the adequacy of the current regulatory system. And while it's a relatively small part of the overall financial services industry, insurance has a far-reaching impact on our economy as a whole. Think of your own experience. The businesses you rely on can't open their doors each day without liability insurance, workers' compensation, and various other coverages. And as individuals, we can't register our automobiles or get a mortgage without appropriate insurance. Furthermore, insurance companies are major investors in the U.S. financial markets with trillions of dollars of invested assets. Finally, the insurance industry fills a less well-known role as the provider of financial guarantee insurance to enhance the credit quality of a wide range of municipal bonds and structured securities. The importance of this role has been highlighted in the current financial crisis. These are sufficient reasons for the insurance industry to warrant federal attention. Yet, in our opinion, there's no need to start from scratch. Any new federal role in insurance regulation should build on the industry's very positive risk management characteristics and the current regulatory structure. Federal oversight also should address the challenges presented by systemic risk, regulatory arbitrage, and an increasingly complex landscape that blurs the lines between insurers and other financial services players. We've made a number of suggestions in our written testimony that I will briefly summarize. First, we recommend a more holistic regulatory framework for the financial services industry that's underpinned by economic capital requirements based on enterprise-wide stress testing. This would improve transparency into an organization's ability to withstand extreme loss scenarios on a consolidated basis. To be effective, federal oversight of the insurance industry needs to recognize the industry's unique characteristics. We recommend that the federal government avoid a one-size-fits-all approach derived from the larger banking industry. And one way to do that is to build an insurance industry knowledge base with contributions from state regulators along with industry and professional associations. Next, the federal government should avoid direct participation in insurance markets. Except in the most dire of circumstances, the private insurance and reinsurance markets have continued to function well and are able to finance a wide variety of risks. While the state insurance guarantee associations have also performed well, we believe a federal resolution authority for multi-jurisdictional and multi-entity conglomerates should be considered. Finally, risk management professionals with appropriate training, credentials, and professional standards can play an important role in the federal oversight of financial services. The current state regulatory framework for insurance requires actuaries to give a professional opinion on the adequacy of an insurance company's reserves to meet its future obligations to policyholders. We can easily envision expanding this role to the evaluation of other financial obligations and hard-to-value assets. Thank you for the opportunity to express our views.
Thank you very much, Ms. Quinn. And next we'll hear from Mr. J. Robert Hunter, Director of Insurance with the Consumer Federation of America. Mr. Hunter.
Good morning, good afternoon, Mr. Chairman and Ranking Member Garrett. I am Bob Hunter, and I formerly served as Federal Insurance Administrator under Presidents Carter and Ford, and also as Texas Insurance Commissioner. CFA has undertaken a major and extensive study of insurance regulation in America, given all the developments in recent times, and we're nearing an end to that. So I'm going to give you today our current thinking, which is expressed in some detail in my written testimony, and I've also answered your questions in that testimony that you raised in your letter of invitation. The tentative conclusions we're reaching right now are these. First, let me discuss what we think Congress should consider. I've gone through all the pros and cons of different approaches in the testimony, but here's where we sort of come out. There is systemic risk in insurance. It's not as extensive as in banking, but we think a systemic risk regulator needs to look at insurance. We believe that in order to fully understand and control systemic risk in this very complex industry, the federal government should take over the solvency prudential regulation of insurance as well. This conclusion is made even in light of the fact that the states have done a pretty good job since John Dingell's failed promises a few years ago in upgrading the quality of their solvency regulation. And looking backward, you might say, well, they probably have deserved to stay there. But looking forward and looking at a systemic risk, we think the federal government needs to move in on some of that area. We don't think the NAIC and the states are up to the task of taking on this systemic risk. Therefore, we think Congress should create a systemic risk regulator. That regulator should also be charged with solvency and prudential risk regulation, and should be a repository of insurance expertise, engaging in such activities as data collection and analysis, and as well as dealing with international insurance matters. It should not be granted, however, vague and open-ended powers of preemption of what remains at the state level. The states are well established in consumer protection regulation with great expertise. They regulate over 7,000 insurers using over 10,000 staff, spending over $1 billion a year in regulating insurance. We've complained about the weaknesses of the state systems, but there are some things that the states do well that the federal government could not match, we think. These include particularly dealing with people. States handle almost 500,000 complaints a year and an additional 3 million requests for information. Several individual state insurance departments handle more inquiries and complaints than the entire federal banking system does. Our recent study of state websites found good and improving information for consumers, and while many states are inadequate in rate and form and other market conduct examinations, we believe that with a few notable exceptions, there's been less gouging in state-regulated insurance pricing than in, for example, credit card, mortgage lending, and some federally regulated practices. The states, being near to the people, seem more responsive to consumers. Therefore, we believe the states should continue to handle consumer protection addressing all the key areas such as claims abuses, unfair classifications, unavailability of insurance, and rate regulation. We think rate regulation is important. Our extensive study of decades of auto insurance data that we've completed a few months ago shows that those states that are regulated effectively with strong prior approval rate regulation also have, interestingly, and this is somewhat counterintuitive, the highest competition as measured by HHI and other indices. I must point out that while we support a greater federal insurance role, we do vigorously oppose an optional federal charter. We think it sets up regulatory arbitrage. We don't think a semi-option solves that problem. We think it would overrule any kind of state regulation. It would be a disaster for states like California. We also believe there are other things you should look at. We should look at the antitrust exemption that insurers enjoy, and we think it should end. We also believe that the FTC should be allowed to study insurance again as part of any regulatory reform, and that federal data collection is very important, particularly for market performance data, sort of like HMDA. These are our preliminary thoughts. The ideas have not been vetted with other consumer groups as yet, but we will be in the coming weeks. Insurance is mandatory, as you just heard, a sort of a public utility. States and lenders require many different types of insurance coverage, and to protect one's family, most people have to get insurance. Consumers can be easily misled by fine print, abused by marketing and claims practices. Mr. Chairman, we ask that you give at least as much attention to enhancing consumer protection as you do to systemic risk as you go through this process.
Thank you very much, Mr. Hunter. And next we'll hear from Dr. Martin F. Grace, the James S. Kemper Professor of the Department of Risk Management and Insurance at Georgia State University. Dr. Grace, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Garrett and the members of this committee for inviting me to testify before you today. As you heard, my name is Martin Grace. I've been a professor at Georgia State for 21 years, and in this background of financial services regulation and deregulation, this is where I've been focusing my work for almost my entire career. Most recently, in the last 4 or 5 years, I've been thinking about this particular problem. In fact, last year we even had a very large conference talking about not federal and state regulation per se, but the optimal regulation of the insurance industry. So today what I'm going to talk to you about is a lot about what I have done my work on in the last couple of years and what I think from an economist perspective might be fruitful ways of thinking about the future of insurance regulation. I have 3 main points. The first point is the proper level of regulation, whether it's state or federal. The second one is the placement of a systemic risk regulator in this functional area of regulation. And I'd like to make some comments on what I believe is the future for the role of states in insurance regulation. My first point basically looks at whether we should have a federal or state system of regulation. The way to think about this is that the costs and benefits of regulation need to be at the same level. So if you think about the local restaurant regulator, the local county health inspector, all the benefits and costs of regulation are really to that county. But the airline safety regulation really has a national audience, and the costs of that regulation should be borne at that level. Now, not everything about insurance is cut and dry. 50 years ago, the insurance was really a local kind of contract, a local industry. But today, only on the average state, about 12 to 15% of the insurance is sold by domestic companies. It is really an interstate business. And as such, if the costs of regulation go beyond the states, it may be a reason for the level of regulation to be moved up to the federal government's level. Okay. My second point is how to think about the risk regulator, the placement of this risk regulator. We can think of this as very simply, in part because if you think about just AIG, its failure caused problems not just across state insurance markets, but across other types of markets, banking markets and international markets. This is not something the state can really deal with. So a federal risk regulator that looked at systemic risk may be something that is important at the federal level. The problem, however, with the application to insurance is that not all companies are AIG. Most insurance companies are really very conservatively run, and to paint with a broad brush might be imposing an extra costly layer of regulation on some insurers. So the devil, again, is in the details about how you choose which regulator or which company is regulated at the federal level under the systemic risk regulator. At the same time, just the signal of choosing a company might be a bad thing. So if a company is chosen to be systemically important and people assert that that choice is based because they might be too big to fail, that will have dramatic effects on the private insurance market. My third point is the role of states in insurance regulation. Insurance regulation, as I mentioned before, has historically been at the state level. And if we think about it, it's because it is a transaction that occurs in or near your house. And that is still true, but it's by a company that could be many states away. So now we have to think about the effect of sort of duplicative compliance costs and the different types of other types of costs that are put on insurers that are paid by consumers and shareholders across the country. So all these states have duplicative regulation, and the question is, are we getting additional benefits from that regulation consistent with those costs? And I think most people think the answer is no. States also tend to be very reactive rather than proactive. One of the things about regulation is that we really have a good idea about the past problems. We never really think about the problems we haven't discovered yet. For example, I was going to mention the asteroid example too. But thinking about things proactively in the future, regulators are really good at figuring out things that happened in the past, but we should have a way of thinking about the future. I don't think the states are really up to that. States react to outside pressure. Congressman Dingell's report some 20-some-odd years ago pressured the states to change. The OFC pressure by the industry is pressuring the NAIC and the states to change. They won't do this on their own, in part because consumers, in many respects, don't care enough and don't make it a salient point. So in sum, I think the states are in a very difficult position going forward because they're not proactive enough. Thank you for your time.
Thank you very much, Dr. Grace. And last, we have Dr. Scott Harrington, the Allen B. Miller Professor of the Wharton School of the University of Pennsylvania. Dr. Harrington.
Chairman Konjorsky, Ranking Member Garrett, members of the subcommittee, I'm very pleased to be here to talk about issues of such fundamental importance to businesses and individuals. I have three main points. First, I want to stress that insurance is fundamentally different from banking and should not be regulated the same way. The anomaly of AIG notwithstanding, compared to banking, insurance markets are characterized by much less systemic risk and by reasonably strong market discipline for safety and soundness. Any new regulatory initiatives that affect insurance should be designed not to undermine that market discipline. Systemic risks, the risk that problems at one or a few institutions may affect many other institutions in the overall economy, is much greater in banking than in insurance. Depositor and creditor runs on banks threaten the entire payment system. The bills don't get paid, the checks don't get written. Banking crises involve immediate and widespread harm to economic activity and employment. Systemic risk in banking provides some rationale for relatively broad government guarantees, such as deposit insurance. But because guarantees undermine market discipline, they create a need for tighter regulation and more stringent capital requirements. That in turn creates significant pressure for many banks to relax capital requirements and improve their accuracy, or to circumvent the requirements through regulatory arbitrage. Insurance is inherently different, especially property casualty insurance and health insurance. There's much less systemic risk and then much less need for broad government guarantees to prevent runs that would destabilize the economy. Guarantees through the state guarantee associations have been appropriately narrow in insurance, or narrower than in banking, and capital requirements have been much less binding. And because they've been much less binding overall, their accuracy is less important. This is good economics. Any new insurance regulatory initiative should follow this model and recognize the distinctions between banking and insurance. And they should also recognize that apparently sophisticated capital regulation can produce significant distortions without sufficiently constraining excessive risk-taking. My second main point is the creation of a systemic risk regulator with authority to regulate systemically significant insurance organizations would likely have several adverse consequences. And I apologize for a bit of redundancy here, going last as I am. In general, the potential benefits of creating a systemic risk regulator encompassing non-bank institutions strike me as modest and highly uncertain. Regarding insurance specifically, if an entity were created with authority to regulate any insurer it deemed systemically significant, market discipline could easily be undermined with an attendant increase in moral hazard and excessive risk-taking. An insurer designated as systemically significant would be regarded by many market participants very simply as too big to fail. Implicit or explicit government backing would lower its funding costs and increase its incentives to take on risks. I'm skeptical that truly tougher capital requirements or tighter regulation would be adopted for such firms, and if so, whether they would be effective in limiting risk-taking over time. Government taxpayer bailouts could become more rather than less prevalent. Even if moral hazard would not increase under that scenario, it's hardly certain that a systemic risk regulator would effectively limit risk in a dynamic global environment. It could well be ineffective in preventing a future crisis, especially once memories of the current crisis fade. In addition, level competition between insurers designated as systemically significant and those not so designated would simply not be possible. The former would likely have a material competitive advantage. The results would likely include higher market concentration, the big will get bigger, less competition, and more moral hazard. Apart from AIG and specialized bond insurers, we've already heard insurance markets have withstood recent problems tolerably well. It's not surprising that some life insurers have been stressed given what's happened in asset markets and the nature of their products. My third and last point is that legislative proposals for federal intervention in insurance regulation, such as optional federal chartering, should specifically seek to avoid expanding the scope of explicit or implicit government guarantees of insurers' obligations. The goal should be central to any debate. Insurance markets, with the AIG exception, have been largely outside the scope of too big to fail regulatory policy. Consistent with relatively low systemic risks, state guarantees have been relatively narrow. State guarantee associations have performed reasonably well. The post-insolvency assessment scheme works well, and I elaborate in my statement how it has various advantages. So I encourage you, when you consider those issues about optional federal chartering, to remember not to keep very close attention to the nature of guarantees and how they can create moral hazard. And last, I would also urge you as part of that debate to consider alternatives to optional federal chartering, whether it be preemption of anti-competitive state activity, or some sort of system that would create greater regulatory competition among the states. Thank you.
Thank you very much, Dr. Harrington. And that completes our panel's testimony. Now we'll go to our questions, and I'll lead off with my questions, if I may. Dr. Harrington, did I understand your testimony really didn't take a position on whether or not we should have a federal regulation of insurance? You seem to be less definite than we should or shouldn't than some of the other witnesses.
I don't have a strong opinion on whether an appropriately designed optional federal chartering and regulation program could be in the public interest. My attention thus far has been very much on the design issue and how federal regulation might be achieved without expanding too big to fail policy and creating moral hazard.
It seems to me, my experience now of the last several years, I think one of the opening statements of our colleagues indicated how simple the question was several years ago as to whether or not we should provide a cheaper product introduction and less stringent costs and effectiveness of hiring brokers, et cetera. That was the question 2-3 years ago. Today, the question's a little different. The question is, should someone not necessarily the federal government, restrict what an insurer can do either domestically or internationally that could have a material effect on their position as an existing corporation such as AIG, should they be allowed to engage in financial products as they did in London in relatively an unregulated atmosphere, and does that jeopardize their insurability of protecting the consumer here in the United States on their various American products? And two, how can we effectively prevent that from happening? I've concluded that if we take no action to prevent this from happening or finding out whether it is happening, I would think there must be 50 entrepreneurs in the world, maybe half of which may not have the highest ethical positions, searching around for relatively small insurance companies, either here in the United States or abroad, hoping to capture them and then leverage them up to huge institutions and engage in playing the market, if you will, the derivative market, as AIG did. I'm not convinced anybody knew what they were really doing over there with perhaps an extreme limited number of people, and they weren't very good at it. With the structures they put together or the purchases and counterparty positions they took seemed to be incredibly poor. Now, that being the case, how are we going to prevent that? Or do we have an obligation to prevent it? Or do we just let the consumers swim by their own survival? Then I'm getting pressure, and I mean pressure from insurance companies and from citizens that are living in the hurricane zone, living in the high-risk zone, that there is not available insurance coverage for high risk at rates that insurance commissioners who are elected to office are willing to allow to be placed on the burden. So it's a beautiful quandary that they're in. Demand insurance companies provide coverage, but underfund the rate that makes them viable and capable of doing that, and then playing the role of a populist. The only way we could prevent something like that, seems to me, is to move it out of the regulatory capacity of the individual states, particularly the coastal states, and take it into a larger entity of control that are less under the influence of either the electorate of the particular state or the insurance carriers that are involved in that state. We get nailed from both ends. Then something has happened most recently that I've been involved, when I say recently, since 9/11 and now with the economic catastrophe. Everybody wants reinsurance, except they no longer want to go to the world market of reinsurance. They want to come to government. And we're being asked to underwrite so many things now as a secondary reinsurer that it seems almost incredible. And people don't see, not even the operators of the insurance companies, see an inconsistency with what they're asking. They'll walk into your office and say, I'm a free marketeer. It reminds me of some of my friends on the other side of the aisle. Except the present company, right? That they're free marketeers, and yet they want us to do something about underwriting their risk. And I find that humorous myself, and really humorous if it weren't as serious as it were. But look what we have now. We have insurance that we offer for floods that don't sustain themselves in cost. So nobody else would possibly grant that type of insurance, but the federal government does. We have excess coverage for nuclear plants in case they explode. The taxpayers on the handle to take care of it, and the premium paid is insufficient to cover the risk. We know that. With hurricanes, floods, and natural disasters, we have substantially the same thing. And now we're starting to get in and offer insurance for business success or continuity. If you're big enough and you get entwined in enough bad deals that could shake the system, such as AIG, basically we have very little choice but to come in. And when I say we, I mean the federal government. Now, I hear some of my colleagues, particularly on the other side of the aisle, say, let's be covered, or let's everybody play the market and what the market's intended to do, and the market provides the equalizer. And I was a great believer in that until I saw subprime loans. And when you look at subprime securitization, everybody's on one side of the transaction making unusual and damned profits, if you will, and nobody's on the other side balancing out or arguing as the marketplace is supposed to do. So it seems to me we no longer have certainly a free market, but now we have a distorted market. We have tremendous demand for support and backup, and I'm not sure we have as many risk takers as we used to have that are willing to get into business with their own equity to manage risk, but in fact are turning to their written or unwritten partner, the federal government, and asking us to provide. And I think the final straw that breaks the camel's back is that, now the request for TARP funds for the insurance industry, a novel concept when you think about it, this industry is probably the greatest defender of free markets, but they're escaping radically from that and going to government subsidy and protection. Are we too late? Can we close those doors? Or do we have an opportunity here to do something, but not do something radical? I really don't believe, I agree with some of the witnesses that when you look at the 200-year, 300-year history of insurance in the United States and managed at the state level, it's been relatively good. The insurance companies have gone bust before, and they have created pools that support and sometimes protect consumers, certainly much better now than they did prior to the original Depression, the Big Depression. But moving now into the international or global market, is that taken as so big, so great, and offered so much financial opportunity for chicanery that we're so at risk that only a governmental entity the size of the United States can get involved? That's some of the questions I have. Now, I know I'm not posing specific questions when I've made that dialogue, but maybe somebody can help me bail out and get out of this question, if you will. What do you think we really should do? Should we try and do something significant, or should we patch, provide just little coverage? We could easily outline or outlaw AIG financial products operations by insurance companies. We certainly can't in the United States. We can't do it abroad. So we could, if we tried to outlaw American companies from doing that, we could give a decided advantage to foreign companies to do it. We've seen we've seen that happen in other areas of regulatory authority, that we literally drive American companies away to foreign markets. Anyway, let's start. Anyone can take a little answer to some of those questions that I've asked. Mr. Wayball?
I think to address your last question first,
yeah.
With regard to the impact of possibly driving industries offshore, I think that, and this can be writ broader, that essentially the way to deal with too big to fail is don't let anybody get too big. And within the financial services industry, it's true that for non-bank financial services, the United States has historically enjoyed somewhere in the $25 to $30 billion trade surplus range. But I think that when you consider the cost of the last crisis, one can make a very good argument that, yes, you might be giving up something in the year-to-year trade balance, but how much do we spend to clean up the crisis that is solved, or that has to be solved when too big to fail actually fails? So that there are costs and benefits to having, to having that kind of industry, and I think that has to be considered. As a counterpoint to that, in the insurance-specific range, the United States has historically has suffered a deficit in the insurance side of the financial services. And I think that that does say something interesting about our insurance regulatory system. The regulatory system at the state level is often pointed to as a trade barrier by our European allies. And it's interesting to see this protected industry that still is under a very significant trade deficit. Does this mean that, would we have an even worse deficit if you didn't have this quote-unquote protection? Or is it the case that because of somehow the state system is not permitting companies to be competitive abroad? So that I think that it brings up interesting questions as to the international competitiveness, and do you really want to be internationally competitive in some of these things?
Go ahead.
Thank you. Maybe I'll take a slightly different tack on this and the notion of systemic risk. And we've had some conversation here today around, does insurance present systemic risk to the economy? And I think about it a little bit differently, that the insurance industry today is not distinct and separate, but it's actually an interconnected part of financial services. One of the advents in risk management over the last decade or so has been something called enterprise risk management. The notion of managing risk across an enterprise holistically, so not managing and measuring credit risk separately from interest rate risk, separately from an insurable risk. And in some ways, to me, the notion of a federal systemic regulator would be the equivalent of a federal chief risk officer for the U.S. financial services sector, for the U.S. economy. I don't think you can separate insurance, and I think it would be unfair to the industry to have other sectors package products, which in their essence are insurance products, under a different set of rules and regulations than the industry is forced to operate under.
Just a couple of points about what you said, Mr. Chairman. The federal government has rather failed in recent years of moving into insurance, and certainly have not made it self-sustaining. The flood program was supposed by now that I ran should have been self-sustaining, but it isn't. In part because the maps are antiquated, in part because there is still unwise construction that should have been stopped occurring. That needs to be done, and the mitigation has to work, and the prices have to really meet the risk. And it can, but it has to be enforced, and it isn't. TRIA, for example, is somewhat modeled after the old riot reinsurance program, except the only difference is the riot reinsurance program charged premiums. TRIA doesn't. The federal government refused to charge premiums when it took on the risk. Now, that's a decision Congress made and the administration, whether that was right or not. The problem is a premium of zero is never going to break even. And so I wouldn't be so pessimistic. You can fix these things. It takes some will, though, because there's always pressure to go the other direction. And then finally, on too big to fail, it's not just too big to fail. I think those are pretty easy to look at and find. But even within markets, consider title insurance. 2/3 of the market is in two companies. Are they too big to fail within the title insurance context? That's why I think the systemic risk regulator has to look at everything.
I agree with that. Yes.
The question about whether the train has left the station, or I guess the horse leaves the barn as well, is a really good one. With AIG and then the life companies asking for TARP money, I've had to ask myself, is basically the safety net has now been extended so far and there's really no going back or constraining it? And I don't think so. I think that the AIG situation and the asset bubble, the housing bubble, is unique enough that if we pay close attention to what happened and why, and think about patching the places where there was a clear breakdown, whether it's the Office of Thrift Supervision or whatever, that maybe we can then think about the bigger picture, which is if we need to guarantee banks because of the payment system, do we want to have that guarantee spread implicitly or explicitly broadly throughout the financial system? And if we're going to have it spread one way or the other, then we probably should make it formal and regulate accordingly. But we'll have to have a lot tighter regulation in principle. But I would think as part of that process, maybe we could revisit the whole issue of what activities are fundamentally central to the economy that require a strong guarantee, and maybe revisit whether or not we don't need to wall off those activities. I was always skeptical with Graham Leach Bliley about how you allegedly can have part of the bank holding company guaranteed and there's not going to be any spillover on the unguaranteed parts. To me, that's in theory fine, but in practice probably doesn't work, so maybe we need to reconsider it.
I kind of agree with what everyone said in many different respects. I think that I don't think it's ever too late to fix a problem. I don't want to ever throw my hands up and say we can't do something. But there's always going to be another problem. And if we get into the situation of just setting up a problem fix and then adding on another fix for another problem and adding on another fix for another problem, then we're at the limit where Scott suggests we might be, where we're just insuring everything. So I think it's imperative that we think about the types of things that we can fix. Using the autopsy example that one of the members mentioned this morning, I think is an excellent example to do that. Find out where the gaps are and use a scalpel rather than a sledgehammer to fix that. That's probably not a very good example, but I think you understand what I'm getting at. My metaphors are mixed. And the second thing, and I like what Ms. Gwynn said, is that the whole sort of academic risk management area now is about enterprise risk management. And if we think about what the Europeans, how they're thinking about Basel II Accords, they're making every insurer be extraordinarily sophisticated about the risks they're carrying. Not only that, their extraordinary sophistication is supposed to be transparent. And the NAIC's way of regulating insurers' solvency is, it's not archaic yet, but it's kind of getting a patina on it where it looks old. And we really need to change that particular solvency system. We need to be moving towards a capital model-based system. And this is something that I think the NAIC recognizes, but that will help. I mean, understanding what our risks are and treating them appropriately at the entire organizational level is a major innovation. Right now, every company is sort of examined separately by the regulators, and they're not put together in a big hole, or in a WHOLE hole. And that's something that I think from the very beginning would go to some extent to solve some of the patches that we need to put in to our system of regulation.
Thank you very much, Dr. Gray. Since I've been so inconsiderate of my colleagues taking considerably more time, and since we have a limited number here, without objection, we'll extend everybody's opportunity to examine to 10 minutes, and I'll be lenient on that so that we can have more concentrated examinations. Is there any objection to that? There being none, then I recognize my colleague from New Jersey.
I guess the only objection will be who is the last person waiting here to...
Yeah, actually, Mr. Chairman, Mr. Chairman? Yeah, if it were possible to have multiple rounds with smaller time limits, I think that certainly those of us more junior on the committee might be enthusiastic.
I think that is an objection.
Yeah.
Then we'll stay with the 5-minute rule. Mr. Garrett, you recognize we'll have many rounds, and I'll duck my next round or two.
Okay. Thank you, gentlemen and ladies. I found your testimony interesting on the systemic risk regulator, and the OFC comments quite intriguing as well, as I continue to learn more about that. I think, I guess we're trying to get the right word for it that we're looking for. We're looking for the optimal, I think that was your word, regulation that we're looking for, not more regulation, not less, but optimal. And I appreciate Randy's comment about the surgical metaphor, and I guess so between Mr. Grace and Mrs. Harrington, what we take from that is, let me step back, a little bit of consensus is being made that as we go forward, this whole global issue that we're dealing with, we need a comprehensive reform and not maybe piecework as far as getting it done, because if you do pieces today, another one tomorrow, and the next one next week, you may not get a total puzzle put together that's comprehensive. So really what we need is legislation that's comprehensive and framework on all aspects. But part of that comprehensive reform legislation that we come up with may end up being, as opposed to something brand new or totally different, maybe scalpel-esque and patchwork-esque portions to it put in. Looking first to Mr. Harrington, you made a comment in your testimony where you used these words. with regard to the OFC and a chance of going there, you said another alternative that you suggest is to encourage regulatory competition among the states. Can you briefly, since I only have the 5 minutes now, tell me what you're espousing there? Oh, there you go.
The idea there is probably more germane to some forms of anti-competitive regulation that exists at the state level regarding prices and price controls and restrictions on underwriting and rate classification, where if you had some sort of a passport system where an insurer could apply to a state to get its primary license from the state and perhaps be subject to solvency regulation in all states that it does business, but that it would be regulated regarding rates and perhaps market conduct or other non-solvency issues by the rules in the state that it gets its primary license. And the notion then would be that companies could choose to go where there was a more competitive environment on those dimensions, and consumers would be able to choose accordingly, subject to adequate disclosure about the nature of the regulation for a particular company.
Oh, interesting. Okay. And the whole issue of arbitrage has only now recently been brought up when we talk about OFC. We didn't really talk about that as much until this whole issue with bank regulation and the arbitrage if you go to systemic regulation and what have you. Just briefly, anyone else on the panel have a comment on potential for arbitrage with regard to OFC that you may get? Yeah, thanks, Mr. Grace.
This is not my idea, but I heard it at a conference I was at recently where I guess he's the head of the policy group that makes up all of the guarantee fund associations. He was saying that there really wouldn't be any regulatory arbitrage possibilities because if you basically chose to be at the state regulator or at the federal regulator, once you choose federal, there's no going back for a large nationwide company. And the reason is that if you're operating in 48 or 49 states, going to the federal regulator means you can reduce your basically compliance costs dramatically. If you threw away all those computer programs and all the knowledge that you built up over the years understanding each state, and then you become a federally chartered company, the choice to go back is extraordinarily hard. It's very expensive. So it's really a one-way street, according to this gentleman. So there isn't a lot of flipping back and forth. I mean, potentially someone could do it, but
you don't see that also in the banking industry. There's not a lot of flipping back and forth
but
with a particular bank.
Banking is different, though, because you only have to obey one state's laws. Going back, if you're an insurer, you have to essentially follow the rules and regulations of every state that you're in.
Yeah. But I think the argument would be is interesting. The argument would be is that with the banking situation and with the regulators, the issue is do we go to under the OTS or the OCC,
right,
what have
exactly.
you.
Yes.
That decision that my bank makes, I'm only going to make that one time because I'm going to end up there and I'm not going to switch back forward. But the argument right now is that's part of the problem that we have is there is arbitrage going on there. But your point is well taken.
But 30 states, according to the Washington Post article recently, 30 banks have returned to state regulation as they see re-regulation raising its head.
Thank you. Appreciate that. And Mr. Grace, you made another comment. You said the states are not proactive in this area, or not in this area, but just states are not proactive in dealing with some of the issues that are before them due to various pressures and what have you. And I think that, I'm quoting you, or paraphrasing your comments, I think the chairman made some sort of comments on opening, and I want to paraphrase you, but Congress is also pretty reactive and not proactive as well. I mean, we're dealing with these issues today. We should have probably been dealing with these issues 10 years ago, but we deal with them after everything blows up, and then we bring you guys in to help us work our ways through. So don't we have that same, and Mr. Hunter, you might want to chime in, and Mr. Hunter might want to chime in since my time is out here as well on the point of we're not the be-all and end-all. You made the comments, Mr. Hunter, with regard to the credit card situation. We didn't, we regulate that. We didn't do a great job, present company all accepted, in those areas. So for either one of you or anybody else, the Fed doesn't necessarily do the job better than other ones, I guess, at the bottom line. Mr. Hunter first.
I've been both a federal and a state regulator, and I know both can fail from experience, and both have qualities that can be good. It really depends on the laws that are in place and how the regulator is monitored and can be good. But both can fail and both have.
Thanks, Mr. Grace.
That's a fair cop. I mean, it's true.
Yeah. The problem is that when the federal regulator fails, such as the case with the OTS and AIG, sometimes the disaster is not only countrywide, it's worldwide. Countrywide, no pun intended, but there is a difference. Thank you very much.
I like that pun. We have Ms. Bean, 5 minutes.
Thank you, Mr. Chairman. My first couple of questions are for Mr. Wabel, and I'm going to give you a couple of them, let you answer them together in the interest of time. The subcommittee's talked a lot about the $200 billion in federal tax dollars that have gone to AIG and how it was essentially focused on the financial products unit, but almost $70 billion in taxpayer money did go to bailing out AIG insurance subsidiaries in their securities lending program. In the current state-based system, who's responsible for overseeing the insurance subsidiaries' securities lending program?
It's a little unclear. I mean, the securities came up out of the insurance-related subsidiaries. Presumably, the insurance regulators at some degree okayed those securities coming up. I've seen different suggestions from the state regulators as to exactly how little oversight they had once the securities came up out of the subs. But presumably, they would have had to approve the securities coming up out of the subsidiaries.
So given the complexity of the securities markets, do you believe that individual state regulators or the NAIC has the sophistication to evaluate these types of activities of the insurers that they regulate? And I'm going to give you two other questions that you can answer as well. Did the passage of Gramm-Leach-Bliley enable AIG to get into the CDS market? And the last question for you is the state system able to properly regulate insurance holding companies and their non-insurance subsidiaries?
I mean, it's really unclear with regard to the securities lending, again, whether they didn't have the sophistication to know what was going on in AIG or didn't have the authority, or whether they just made the same mistakes that everybody else did, which was thinking that AAA-rated mortgage-backed securities actually were good things to be investing in. With regard to Gramm-Leach-Bliley, from what I can tell and have been told, prior to Gramm-Leach-Bliley, prior to becoming an Office of Thrift Holding Company, Office of Thrift Supervision Holding Company, the AIG at a holding company level would have been essentially unregulated.
Yeah, if they didn't have a thrift,
right.
they wouldn't have had
So
OTS
AIGFP existed before Gramm-Leach-Bliley, and it seems to have been primarily pressure from the Europeans to have a sort of national level regulator that drove AIG to become an Office of Thrift Supervision Regulated Holding Company. So that in terms of that specific aspect, it appears that if anything, Gramm-Leach-Bliley may have increased the oversight on AIG, not lessened.
because there would have been none.
Yes. I'm sorry, the last point was the state.
Well, you know, I'll hold it at that for right now, and then I'm going to ask Mr. Grace. I have a little more time left. With regard to multi-state and national insurers, if you were to start from scratch in designing an effective regulatory structure, would it be national or would it be state to state?
What was the very first part of that?
If you were building the system from scratch, not from where we are.
Multi-state? It would definitely be a federal system. I mean, the way I was thinking about this before was that if we had an OFC, it would be, kind of thinking from a theoretical point of view, it would be the small single-state or two-state companies that would stay sort of locally chartered, and it would be the larger interstate companies that would move to the federal charter. That's kind of the economic theory, perfect world argument. And I realize that some of the larger ones may stay state and some of the smaller ones may choose a federal one, but the whole idea there would be a separation between the two, and I think that would be the right way to think about it.
Oh, thank you. I have two other questions for you. That is, when the NAIC was founded in 1871, its stated purpose was to enable commissioners to work towards consistent laws across all states, which clearly 140 years later hasn't been achieved. Are there any real incentives for states to work together to create that uniformity?
I think that there are a number of people of goodwill that that really are trying very hard right now in response to the OFC push by the industry. But there's so many different state interests at stake that I can't think, they won't all play together. So we'll never actually have a uniform system.
I have a question for Mr. Hunter. In the bill that Congressman Royce and I introduced, we set the minimum for market conduct regulation at the national NEIC, or the NEIC market conduct model laws. That's the starting point. Do you think this is an appropriate place to start for consumer protections? And besides rate regulation, would you suggest anything additional in terms of consumer protections?
The NAIC market conduct model is not sufficient. You'd have to get, for example, it doesn't collect market behavior data like HMDA would collect, which I think is important.
Does it collect which data? I'm sorry.
HMDA type data, so it's not sufficient as it is, and rate regulation is vital, we think, to any good protection for consumers, and actually improves competition.
Anything beyond that you would add?
Oh, yeah. Well, I'd have to go through the whole model, but we had a whole list of complaints I could send to you if you'd like.
All right, thank you. I'll yield back.
Gentleman from California, Mr. Royce.
Thank you very much, Mr. Chairman. And I'm going to pick up on some of the questions that Congresswoman Bean had asked, and I appreciate, Mr. Webble, your response to that. I'd also ask this of Mr. Grace and Mr. Harrington. Much of the focus of AIG's failure has been on their speculative use of CDS. There's been a lot of discussion as to whether CDS are insurance products and should have been regulated as such. There's no dispute, though, that state regulation failed to detect and address a number of these major problems with AIG. And in February of this year, the report surfaced from the Wall Street Journal, and I'll quote from that: from $1 billion in 1999, AIG's securities lending portfolio ballooned to $30 billion in 2003, and then $60 billion, and as Melissa shared with you, it then went to $70 billion. Much of that growth came from lending out corporate bonds owned by AIG's large life insurance and retirement services subsidiaries, unquote. So over a period of about 7 years, AIG bled the assets of its insurance division, shifting these investments into an overseas casino-like CDS operation, while going completely undetected by the state insurance commissioners responsible for ensuring the solvency of its operations. Now, here's the punchline. Only when the company was on the brink of collapse, after multiple publicly reported restatements of earnings, did New York State Insurance Commissioner and Governor propose to redirect $20 billion from the surplus of AIG's insurance company to its parent holding company. Now, fortunately, that plan was aborted. But that's the scale of regulation and due diligence, an oversight that existed. It turns out the problem was much bigger than state officials realized. And of course, the federal government intervened, and the American taxpayers are asked to cover one of the most expensive corporate bailouts in our history. Now, surely there was failure throughout AIG and throughout the regulatory structure overseeing AIG, but doesn't this tragic episode underscore the inability of state insurance regulators to exercise effective oversight of today's large, complex insurance companies? And I again think that Congresswoman Bean is on the right track, and I'm a co-sponsor of her bill, when we try to give a world-class federal regulator here not only the authority but also the information to look at the entire financial institution that's involved in insurance and all of its affiliates. It just seems to me that, Mr. Huntington, that in the wake of this mess, on top of all of the other arguments, as I say before, you know, we have a national market in everything else and a balkanized one in this product. But now on top of it, we deal with this problem. So I'd ask you, Mr. Harrington, your observations on that, and Mr. Grace as well.
I would like to see a really detailed analysis of the securities lending issue and exactly what happened, why it happened, what the nature of the breakdown was, to what extent New York's insurance department and various other state regulators may have been asleep at the switch. Securities lending had gone on for so long, it had been a major part of so many operations. I think it was regarded as routine business with no mischief involved. Well, clearly now it appears there might have been some real mischief. So there could seriously have been some state regulatory failure there. I would want to really look into the specifics of the securities lending. But I have to go back and say everybody failed here. The OTS failed. Foreign bank regulators failed. They were letting foreign banks load up on AIG paper, CDS paper. Presumably, if they were doing their job, they would have said, how can we have so much of our banking system dependent on the promise of a single United States institution? Bank regulators failed. I don't know about the comptroller, but the Fed, in many respects, must have failed to allow so many banks to contract with AIG, given that it was running amok, so to speak, on these dimensions. So the Fed was partially to blame. The FDIC seems to have been to blame. The SEC, you can lay a lot of blame at their feet. And then also the Federal Reserve in general. I mean, we don't want to go to low interest rates and what that did to the incentives in the entire system. But my point would just be, you may well be correct.
Listen, I happen to agree with every point you said, including the central banks worldwide running negative interest rates in terms of inflation for 4 years running. Sure, all of this fed it. But that's my point. Every one of these entities that you've cited had a little piece of this puzzle. And what worries me about our failure to address the fact that we are not ready to embrace giving a world-class regulator the ability to have the overarching piece. I'm not saying that regulators are going to catch every mistake, but by God, when you're leveraged 170 to 1 and nobody catches that, that's something that can be caught and probably can only be caught by giving one regulator all the pieces of the information. And that's why Congresswoman Bean has introduced this bill, and this is why I think she's right in this approach, in addition to a dozen other reasons. And so let me, Mr. Harrington, agree with your assessment, but to say at the same time that it is the leveraging on top of all of the rest of this, and the fact that that couldn't be caught because of the piecemeal patchwork quilt approach here. And Mr. Grace, let me ask you for your observations as well.
Thank you. I guess I agree with both of you. I mean, this is a hard question, and it really is. I think it comes down to this. Now that I'm thinking about it, if we had one more regulator, and let's say there was 50 regulators. I'm not talking about the state, but I'm talking about federal regulators, foreign regulators, some state regulators. There were 50 different entities looking at this in some way. Would adding even a state-of-the-art world-class regulator, would they have caught this? And I remember talking about...
But the question, Mr. Grace, is because you assume that those 50 each have... you've got that problem. And that's what I think is the root of the problem here.
Would the question would be also then, if you had this world-class regulator, would it not fall into the same complacency trap? I mean, I agree. I think we should have something that's like that, but I don't know that it's a cure. Maybe it's another...
I understand the point you're making, and let me say that, Mr. Grace, I agree that counterparty due diligence or market discipline is the most important factor in all of this, and that can be circumvented, unfortunately, when the assumption is made that somebody's looking at it. So I agree with that philosophy, but I have to say that in order to catch this type of over-leveraging, I think this would have been caught by a world-class regulator if they had access to all of the information. And I think it's the sheer amount of over-leveraging here which created this systemic risk. So I'm not saying that this would solve all problems. I concur with you on that. But I would ask if you'd grant me that point.
170 times over leveraging just boggles my mind. I mean, I don't see how somebody, I mean, I still agree with you, but I just don't see how someone didn't see that. I mean, so if...
Neither do I.
Okay, if there's all these people looking at it and thinking about it...
Nobody had all the pieces.
Yeah, that may be...
That's the problem. Anyway, thank you, Mr. Chairman.
Thank you very much, Mr. Royce. The gentleman from Ohio, Mr. Wilson. You've been waiting now, Mr. Wilson. Go to it.
Thank you, Mr. Chairman. Ms. Gwynn, did you have a comment to say?
I was just going to add to the prior conversation that this notion of regulatory arbitrage, that my point is very much related to the one that you've been making, Mr. Royce. It's around product level regulatory arbitrage, and the difference between the financial guarantee insurers and the credit default swap markets is the primary example. It's a poster child for this. The financial guarantee insurers have experienced substantial losses. Their loss ratio last year was on the order of 300%. But by and large, they're still solvent. And they're solvent because of perhaps two factors. One is that they were required to hold capital against the policies they wrote. And secondly, the nature of their contracts had a more sensible limit on what the terms of the coverage were. The credit default swap market, on the other hand, was largely unregulated, limited capital requirements, and for the buyers of those contracts to be comfortable with counterparty risk, the nature of the contract terms and the liquidity pressures that they had inherent in them actually caused the triggering of immense losses.
Okay.
Thank you.
Thank you.
Would the gentleman yield for 1 second?
Certainly.
I think she made my point. It was the investment side of the business that put at risk the underwriting side of the business, and that's why I think you need a federal regulator to prevent that and to look at that. So
Okay. Thank you. I would like to say, as a former state legislator, I've always been very pro keeping as much regulation local as possible. But with what we've seen happen in this last go-around with AIG and how we're going to be able to curb the systemic risk, I think there's ways to look otherwise than what my theory would normally be, and that is to keep it at the state level. In Ohio, we always had the Department of Commerce, and the Department of Insurance was part of that, and no real problems. But we certainly weren't doing deals like had been done in New York, and I think that was a big part of it. My questions start with Mr. Webbo and then come down, if I may, to Dr. Harrington. So, Mr. Webbo, first of all, one of the comments you made earlier, and I thought it was really something we should focus in on, is too big to fail. And so if you'd go back and touch on that for me, then I have a second question for you.
Well, I mean, the point is that, the question of competitiveness at an international level is frequently brought up when you talk about too big to fail. The Citibanks, the Bank of Americas are competing on a global level with Deutsche Bank, with Royal Bank of Scotland, in a globalized financial system. And this gains the country an immense amount. But if you approach too big to fail, and say, we're just not going to let things get too big. One way to do that, one way to say is, okay, you have a systemically significant institution. We're going to put additional capital controls on it. We're going to put additional regulations on it to make sure that it's not as likely to fail. Another option would be to just say, we're just not going to let things get that big. One of the counterexamples that people frequently point to is this lack of competitiveness, that you're not, other countries are doing this, they're letting their institutions do this. Our balance of trade will suffer. And that's true. I would just point out that there are a lot of places in policy where the government basically says, okay, we could let the market go this way and it might make more profit. But for a social reason, we're not going to let it go that way. You could mine in Yellowstone National Park. At a society, we say we're not going to do that. If you look at the cost of the crisis that we're in, one might conclude that it would be worth it to say, okay, if other people want to let their banks like Iceland get to be 40 times the size of their GDP or whatever it was and then collapse when their banks collapse, they can go that route. We're going to say no. We're going to accept the fact that we're going to be uncompetitive in this particular area, but at least when the crisis hits, we're not going to suffer like they do.
I'd like to follow up on that. If we can drill down a little more and say that, Americans just by nature, we're going to be competitive, and we're going to want to be competitive with every country out there. So it tells me that if we're going to do that and we're going to control systemic risk, then we're going to have to put the controls in so that companies don't get too big to fail. So given that nature, what would you think? I know you mentioned the capital markets and controls. Could you be more specific?
Well, I mean, the most basic level is simply the amount of capital that you're going to have an institution hold. In response to an argument that we sometimes have among my colleagues, I came up with 3 reasons if you just did these 3 things, you wouldn't have had this crisis. One of them is simply you don't let institutions get so leveraged. I mean, it is generally within the purview of most of the regulators that we have, certainly the banking regulators and the insurance regulators, to determine how much capital the institutions are going to hold. Now, of course, if you hold more capital, you do make them, again, less competitive. Yeah. They are going to be making less profits. But the flip side is that they are less likely to fail and less likely to need a takeover and possible government bailout when they do.
Good. Thank you. The other part is you had mentioned about the United States deficit insurance. Could you comment on that?
Basically, I mean, it's convenient because the balance of trade accounting has 2 specific columns in it. One is for essentially insurance services, and one is for non-insurance financial services, i.e. primarily banking and securities. So, I believe they release the data quarterly, or it may be annual. When they release the new data, it's very easy to go to the website and say, okay, this is the amount that the trade deficit was in these services for the past year or the past quarter. And so you can look at it very clearly that it is fairly striking that in non-insurance financial services, we have consistently run a fairly substantial surplus. In insurance financial services, we have consistently run a fairly substantial deficit. And there isn't necessarily anything wrong with that in a sense that, in the automobile industry, if you looked at imports and exports of SUVs versus small sports cars, the Germans and Italians probably import small sports cars, or we import them from Germany, we would export SUVs. So it's not unheard of to have the same industry with differentiation among product types, but it's still interesting to note that our banking system, our security system seems to be very competitive on the world stage, and the insurance system isn't.
Thank you, Mr. Webble. Dr. Harrington, if I can, you had talked about regulatory reform, and you had mentioned earlier, I believe it was to Mr. Garrett, in regard to what approach you think would be a good idea. Could you restate that?
My main comment was one, that if we move towards having an optional federal system of regulation for insurance, that the whole issue of how we decide to guarantee some insurers' obligations will be critical in determining how much we may lessen market discipline, increase moral hazard, and actually undermine safety and soundness. So if we go that route, that's just a linchpin of what needs to be done. The other thing I just said, though, is that I'm by nature an incrementalist, and I wonder if targeting certain problems with state regulation through less intrusive means that wouldn't require some of the risks that are associated with a federal regulator couldn't achieve lots of the potential efficiencies that might arise from some sort of change. Now, to be sure, the types of things that might be done there have become they've sort of moved off the front page of the papers today because of the asset crisis and the housing crisis. But I'm talking about things that would allow consumers maybe to have more choice in ways in which they buy products and the types of products they buy without having to abide by certain types of regulations at the state level, whether that be a passport system or whether it be some sort of federal preemption of certain types of regulation that deprives some consumers of really the ability to get low-cost products because of the way the price is regulated.
Thank you. I like especially your second suggestion there. Thank you. Thank you, Mr. Chairman. I yield back the balance of my time.
Well, thank you very much, Mr. Wilson. Now we'll hear from the gentleman from Illinois, Mr. Foster.
Thank you. Well, my first question, I hope, is a simple one. Can any of you assure me that there either are or are not other mini AIGs hanging around there, that they're insurance companies that could explode tomorrow and have systemic risk?
We can't ensure the future. But in looking, I have specifically in the past looked at the securities lending aspect of the AIG and into the sort of other insurance companies and what their securities lendings look like. And from what I found, there wasn't anybody else that was approaching it nearly to the level that AIG did. And this was definitely a big way that they failed. So it doesn't look like that this explosive failure is coming from that direction.
I would agree with Mr. Wabel that in terms of participation in the credit default swap market and securities lending, coupled with the scope of AIG's operations, the complexity of it, the number of coverages it wrote, the number of legal entities, is pretty unique in the industry. That said, there are other large companies, and each company bears its own risks. So if there were the big quake came to California tomorrow, could other insurance companies, perhaps large ones, be impacted? I think
that's on the underwriting side more, so which it's always going to be there.
It depends what your projection of what goes on with the economic situation. If it continues to deteriorate, you have several large life insurers that might be at risk.
Let's see, my next question is, Alan Greenspan and others have this interesting suggestion of dealing with too big to fail by simply imposing increasingly stringent capital requirements so that they would increase non-linearly as you increase in size, and that eventually there would be a motivation for a company that as it grew bigger to split in two to get higher returns for its investors. And I was wondering if you have a reaction if that would be appropriate for the insurance company. Yes, Mr. Harrington?
I'd say with regard to the insurance sector, if we can get beyond AIG, that capital requirements have been such that most companies have held vastly more capital than what's required by the requirements, especially on the property casualty side, so that because of market discipline, many property casualty companies are really well capitalized, and a lot of life insurance companies have. In principle, if you have moral hazard problems and real systemic risk problems, I think this idea of increasing capital requirements and increasing them more, the more risk you take on, makes some sense, but I'm so skeptical about whether it will ever work in practice, because if you look at the last 20 years of banking regulation, the name of the game has been the move towards ostensibly sophisticated systems that in effect allowed banks to reduce the amount of capital they held. So I'm just skeptical that you can actually make that type of system bite. In theory, I think it sounds like a good idea.
Right, and well, a related suggestion is to have a fund, to pre-fund the systemic risk thing, and by basically, taxing increasingly large institutions, which is another, obvious possibility. But let's see, another attack on the too big to fail problem has to do with just enforcing compartmentalization. And when you talk to Ed Liddy about this, he is just dismayed at the prospect of anyone trying to run a business that was as diverse as that. And that simply, if you'd had the individual business units of AIG grow, become profitable, and then at that point just return dividends to shareholders, would reinvest it wherever they thought it made sense. And by enforcing compartmentalization as a way of dealing with too big to fail, it also makes the regulator's job a lot easier. And I was wondering if you have a reaction to that as a possible solution for the insurance industry.
Well, I mean, it seems to some degree that the insurance regulators were fairly successful in doing that with AIG. I mean, by all accounts, the insurance subsidiaries compartmentalized are okay. So that if you had taken AIG into a bankruptcy and split off all of the FP and the other products and just had the insurance companies go forward, they would have been okay. But we still ended up with a mess in AIG.
Yes. Yeah.
I was just going to say, I was a little unsure how they would do the compartmentalization, but if you mean to make the companies more of a monoline type of thing, that could
For
be
example, yeah.
that could be a serious problem because you could be a pretty small company and be a very large player in a single line, and your small company insolvency could actually have some significant damage across, depending on the line, like if it was bonds.
Any other comments on it?
Any compartmentalization, I think, would be broadly between insurance-type products and other products. I think there are lots of gains from diversification within insurance-type products. It's when you get into all sorts of ancillary products where the regulatory burden really becomes large. And, of course, that's also true in banking. And in my comments before, I think we have to really think about whether or not we shouldn't maybe have more restrictions on activities if you want to go to the deposit insurance till and be able to get that type of protection for depositors, maybe you have to give up some of your choices about what activities your overall entity would undertake.
Okay, thank you. I guess my time is up, so I'll yield back.
Thank you very much, Mr. Foster. Appreciate that. Now, Mr. Grayson, recognize you for 5 minutes.
Thank you, Mr. Chairman. There's been an awful lot of discussion about whether we should regulate. There's been a lot of discussion about who should regulate, and much less discussion about what the regulation should be. Let's assume, for the sake of the argument, that we agree that something went badly wrong in the case of AIG, and that bailing out AIG is not the best use of $100 billion of taxpayer funds. Somewhere along the line, somebody should have had the authority and the guts to say to AIG, you're doing something wrong, you need to stop. And what I want to hear from you all is I'd like to hear your best ideas about what the substantive rules should be in order to avoid a recurrence of the situation that we've had with AIG. And I'm talking about specific limits, because I'm concerned that if we simply say to a systemic risk regulator, you figure it out, that's not being responsible. So we have to come up with rules that we can actually apply with some degree of regularity and avoid the problem that we've seen over and over again in this industry, which is capture, where the regulated becomes the regulator. So let's start with Mr. Hunter. What are your best ideas about when to tell AIG or any other insurance company that enough is enough?
Well, again, I think this is the role of a solvency regulator, solvency/systemic risk regulator, and that there should be specific limits on leverage.
What limits?
Well, it may depend upon the line of insurance. I mean, it does depend upon the line of insurance. If you're writing earthquake, you need a lot more capital than if you're writing life insurance.
Give me an example of when you would say enough is enough.
For earthquake insurance, I think you need at least $2 of capital for every dollar of risk. For property casualty insurance, you may need only $1 for $2 of risk. Depends on the line of insurance there, too. So you can come up with leverage limits. You can come up with size limits. I mean, some companies shouldn't grow beyond certain limits, particularly in markets. 10%, maybe a limit should be 10% within a line of insurance. For example, in a state, no company should get bigger than that. So that to enhance both competition and to make a failure less damaging.
Is there a certain size when you think that enough is enough when it actually is beginning to invoke systemic risk? I mean, we know that a $1 million insurance company is not involved in systemic risk, and a $1 trillion insurance company is. Yeah. Tell me where you think the line is.
I don't know. I haven't done the analysis, but I think it can be done. And again, it may vary by where you're writing and the kinds of risks you have in your portfolio.
Mr. Harrington, when is enough enough?
I'd like to think I would know it when I saw it, but I would not be able to opine on that outside of the context of what in particular I was looking at. Clearly, it seems to me that someone with knowledge of what was going on at AIG should have been able to say enough is enough. Nobody did.
You see, Mr. Harrington, that's the sort of fundamental problem, because if you were the systemic risk regulator and you were faced with this situation, unless you had clear rules to apply, you might just say, I'm just going to not deal with it. And that's the problem we're going to face unless we come up with specific rules. So let me hear from Mr. Wiebel what you think the specific rule should be.
I really don't have, the difficulty is that the financial services industry is mutating so quickly. Writing specific limits into laws puts you in a very difficult situation. I think that looking at market share is probably a reasonable place to start, but in doing that, to some degree, you are also cutting off consumer choice. I mean, if an insurance company is doing a great job and I want to buy insurance from them, and then the government comes along and tells me, oh no, you can't buy from them because too many of your neighbors did. So I would really like to have a good number to tell you, but I'm sorry, I don't.
Mr. Grace, when would you put your foot down?
I can't answer it directly, but I can give you an analogy that I think works really well. 20 years ago, when Congressman Dingell had his hearings, he put the insurance regulators to the test. And they came up with a system. And I said, this is the thing I was criticizing before. I think it has a patina on it now. But it was specific rules that happened when certain things occurred. And the regulator had no choice. Or its choice was constrained. You know, he had to either shut it down or he had to investigate it. But it was something that had to be done. What we're talking about here, there isn't a rule that is applicable to every single company universally. Something else I also said was that the Europeans are going to this capital model, and they are putting all of the firms within an enterprise together to assess the type and the quality of capital and how it's going to support the risk that it's writing. And it may be that that test can be used in a, what was the risk-based capital rules is what I'm talking about, but there were mandatory requirements that the regulator had to engage in when certain things occurred. Science has to be developed to develop those rules for current insurance and insurance-like enterprises. We don't have it yet.
Well, my time is up, but I will invite you to supplement the record and tell me directly what your best thoughts are on the subject. And I honestly find it a little disconcerting that 5 people who are experts in the industry and could end up being the systemic risk regulators for insurance, any one of you, would find it so difficult to answer a question like that. I'm not blaming you for it, but I think it illustrates what a conundrum we're facing here, and I want your best thinking about how to solve it. Thank you, Mr. Chairman.
Well, thank you very much, Mr. Grayson. I want to thank the panel particularly before we close the session down. The interruption for an hour and 20 minutes was unexcusable, but that happens to be the way the House proceeds. I want to thank you very much for coming and being part of this panel specifically, and I'd like to ask you to join us again. I hope maybe we could do something in a roundtable discussion where we could have byplay back and forth, because I think you have a wealth of knowledge that certainly I'm convinced we here on the subcommittee need that knowledge if we're ever going to accomplish something. So again, thank you very much for coming, and I just want to caution you that we note that some members may have additional questions. I know Mr. Royce does of this panel, which they may wish to submit in writing. Without objection, the hearing record will remain open for 30 days for members to submit written questions to these witnesses and to place their responses in the record. Before we adjourn, the following written statements will be made part of the record of this hearing. The American Academy of Actuaries and Mr. Eric D. Gerst. And without objection, it is so ordered that they are part of the record. And now the panel is dismissed, and this hearing is adjourned.